All right, so we had a very good week here this week, finishing up again, kind of like last week, where we had such a strong start before Monday even opened. We had such a strong start. The rest of the week, until this last little push after Trump's press conference here today, up until the press conference, we were flat on the week after the open. We got a late little push here that gave us some gains again from the open on Tuesday. So we've had a couple weeks where we had strong opens and then kind of sideways action after that. But was this past week strong sideways action strong enough to hold some really good breakout patterns? So I'm going to show you what those are, and I'm also going to show you some canaries in the coal mine. Nothing too looming, but just some canaries in the coal mine out there that suggest that while we've used a lot of energy and momentum to finally achieve these bullish breakouts that can establish bullish trends, not just bounces, like severe oversold technical bounces, but trends. With all the energy we've used, we might just run out of gas a little bit. So I'm going to show you where what those are telling us and how far we might just pull back to, if we do. In the very short-term level and where any support levels might be there. So I'm going to break those down. And we're going to talk about a stock that's got an opportunity for a pretty big breakout itself based on some of these different intermarkets, different markets and how they relate to what's going on with equities and risk appetite as a whole. That's going to be our trade idea. So let's go ahead and get started. Today is Friday, May the 29th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 here with the Market Forecast Indicator. So we finished today off of the lows, which is a very good sign. We were, as we were coming towards these lows, there were some pretty negative patterns showing up on here. The near-term line was getting closer to 50. The momentum line was really close to dropping below the 5th percentile. So the fact that we finished up actually at the highs of the day was a good sign. It did keep the momentum line from getting even in the lower reversal zone, much less to an extreme low again. Again, it can muddle around here in the middle. It's just when you get one extremes, it should be followed up with some others. In other words, like, if all the selling's occurring during the day, then there should be some buying that comes on during the day. But we're not seeing that. We're seeing the buying overnight and the selling during the day, and that's why you see this big discrepancy here between the momentum lows and the lack of momentum highs in the upper reversal zone. At least the near-term line's getting there. This has been the concern here. It's even more pronounced, say, like on the Dow Jones. You can see a much higher high with the lower highs there. The NASDAQ composite still hasn't formed its high, the second high. It's still moving higher, but you can see, it already had a divergence showing up. This would be another one. And then finally, the Russell 2000, its near-term lines actually come down already, showing, this. On Wednesday, we talked about this move here, this break above the 62, culminating or ending this catch-up period. And I spent a lot of time in Wednesday's video talking about that. Very similar to what we saw there, and you can see so far the ups and downs that followed there. There's an opportunity for that up and down to follow here too. So we'll see how this plays out over this next week, how the rest of this weakness, potential weakness, plays itself out. So the low point in between the divergent highs, this low is right there. So that would be your target. So that's down to 29.40. That would be the target for the divergence on any near-term pullback where the blue line dips below 50. That's 100 points down from here. So that's not, that's nothing. It's, what, 3% drop. So that's pretty. That wouldn't be like huge, but it's not like minimal either. That would be a significant move. If we did break through that low point, though, then there's a good chance the intermediate line breaks down. And remember, the Russell already had the intermediate line breakdown. The only reason why the S&P hasn't is because the NASDAQ, and really the NASDAQ 100 especially, is not even close. Now, if you look at the NASDAQ 100, we're at 95.55. Its 23% level here is at 8,900. So what does that say? That means we can fall here, in any kind of near-term weakness, we can fall 655 points down to 8,900. and produce a light pink shading, most likely, produce a yellow line, and still not be as a retracement. Because once you break the 23%, that's really when the retracement starts. And if you do break that, you have a good chance the intermediate line pulls below 50, right? See, when it drops below 50, that's a retracement. When it drops below 80, that's not necessarily a retracement. Here, dropping below 50, it's a retracement. Dropping below just dropping below 80 again. Well, you have to go back a little bit further. But just dropping below 80 here is not a retracement, and dropping below 50 is. So you get the idea. So you have to kind of break. You have to break that 23% line for us to say, okay, there's a good chance the intermediate line does come below 50, and then it's a matter of where. Where is that pullback? Is it going to end at the 38? Is it going to get inside the retracement zone? Is it going to get to the bottom of it? Is it going to hit the midpoint? Those are all levels of support to watch for. But it doesn't really matter. So in other words, you can get lots of ups and downs between wherever high you end up with currently here. But if we go up a little bit more, you'd move it up a little bit. But between wherever the high is and that 23% level, you can go up and down pretty easily. And the more we go up without a pullback, right? The more we go up without ever breaking, because you notice, with all these highs here, we still, that was the closest we got. But you can see how easy it was for it to drop and stay above the 23% level. When you got to this high point here, you can see that pullback didn't even come close. That one, this high point, that one did touch. So that 2-day drop coming out of April expiration, it did touch the 23% retracement, but it didn't go through. So no retracement there, and we just bounced off of it to a new high point. So the higher you go up, you notice, without a retracement, so without a break of the 23%, the higher the high goes up, you'll notice the wider the gap between the high and the 23% gets, because it expands. See how, when you're down here, it's really small, really small. But as you go up higher, the gap between the 0 and 23% level gets bigger. And again, that's just noise. It wouldn't be any trend changing at all. It wouldn't even look for an intermediate. You wouldn't even expect the green line to fall below 50 on any move to all the way to 8,900. That's a pretty significant move. So keep that context in mind. If we were to break this level and make a run towards, say, the 50% line again, down to 2,800, that would be coincident with the NDX just hitting its 23% level and not really forming a retracement. And remember, we are actually still in retracement mode on the S&P of this decline, right? Because we haven't broken above the 78% level to start a new trend like we have on the NDX, and especially we haven't done it on the Russell 2000, which isn't even close to getting above the 78. But it had a nice good catch-up run, and like this catch-up run here, led to some weakness, and that's kind of what we're seeing right now with the pullback that we've seen the past couple of days. Even with the Qs itself being up today, for example, and the Russell being down most of the day. So this great rotation trade back into small caps, again, like we said on Wednesday, was mainly just a catch-up trade. It wasn't a new trend. It wasn't a new rotation. It had done it before, but just did it again. And now we're getting back to the normal leadership, which you want. We want these large cap tech names to be the leadership. And I know I was tweeted at with that quote that we want the Qs to lead. We do, right? We want the Qs to lead. We don't want the trash to lead, right? Because the Qs were leading this whole time, and then their leadership went parabolic here. It's not a recent phenomenon. The Qs have been leading this whole time, and they led during the decline, and they led during this rally up to that point. And then the Russell made a catch-up trade. The Qs retook the leadership, and the Russells made another catch-up trade, and that's it. So yes, we do want the Qs to continue to lead us up higher. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this red button right here. Hit the subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. That notifies you when our videos are posted here on the channel. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one on Monday. It's a quick way to give us feedback and let us know you like our videos. You want us to keep doing them. If that's the case, click that thumbs up right now. You can do it right now while you're watching. If it's not the case, you don't have to click on anything. And also comment down below. What did you get out of our video today? What do you think about any questions or comments you have about anything I talk about here? Post it in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, there's a lot of other things too that we provide here on the sides and around the video here. There's a little bit of a paragraph catch up. This Market Outlook live trade review videos, every day I do the Market Outlook. I do a live video at 3:30 Eastern time. I review all our past trades that I've made. That's a highly requested thing I get from people. Hey, can what about that trade you did a week or two ago? Can you check that out again? Well, we actually make the trades in our class portfolio, and in this video here, we review all those trades, the ones that we're still in. And then we also put on the trade idea you'll hear at the end of the video. We've already put it on in the live video right before the market close. That is a feature that's available for all of our monthly subscribers in addition to all of our classes. So when you go to our classes, for example, if I click on this trading rooms, it takes us to our schedule, our class schedule. We do 8 trading rooms a week. Our monthly subscribers get access to all of our trading rooms, and you can see everything else you get here. That's our monthly subscription. Our premium subscribers get a lot more. You can check out what they get, and there's a link right there that takes you also to your monthly plan. Also engage with us here on social media. Click that heart. It opens up a new window where you can like today's Market Outlook tweet. Click that thumbs up. Same thing, takes you to your Facebook page. That benefits us. The more likes and replies and retweets these posts have, the more Twitter and Facebook will promote our content to all of our followers. The more you engage with them, then Twitter and Facebook will promote all of our content in your timeline to make sure that you see all of our stuff. All right, so we had a really good weekly candle on the S&P 500, and this is probably the most bullish pattern out of anything that we could see right now on the S&P is this line. Now that blue line is coming across these highs, so take that blue line there with a grain of salt in terms of what it represents. It's coming across the top of those highs. You can see we held it for some resistance there before that breakout, kind of a swing breakout and then break down below this low point. Well, we got above that support channel, and now we're kind of looking to get above this one, this old high channel that we had. But still, closing above all these highs was and above the 200-day moving average. And not only did we get above, but we got pretty decently above the 200-day moving average. You can see some other instances where we got decently above it, and we might have slowed down and retested, but at least we stayed above on the retest. If we get any kind of weakness out, now we might retest at 200, but that's a pretty decent breakout. Last week we were flirting, this week not so flirting anymore. Now if we break that back down below the 200, which would be breaking back below the 62, if we do that all like say in the next week, then that's not so good, right? That would be a fake out like no other pattern, and those are pretty bearish, but that's unlikely. That's your low probability scenario because of the Hakinyashi pattern. Breaking above the highs, no low point. The midpoint of the candle next week's going to be right around the 200, so right around 2960 is where next week's Hakinyashi candle will open, and we are near the high, right? So we're trading at 3044, so that's where the next week's close will start out, is at 30, depending upon where, whatever gaps we might have. But that means we're going to start off next week with a pretty bullish candle. And if we get a higher high, and especially if we close above, if the Hakinyashi closes above 3068, which is a good chance considering how close we already are to that on the actual basis, then we can just keep on rocking, right? You can see how that kind of a trend is just keep on rocking on the Hakinyashi level, even with some ups and downs and retests. These retests aren't trend-changing retests, and we're really close to seeing what we already see on the NASDAQ. The Dow is just barely getting to the 200-day moving average, so there is some issue there. with resistance, right? And then of course the NASDAQ, let's go to the NASDAQ 100 here. It's already busted through. Now it didn't close above the high, but it's got very, very bullish candles. It's still working and working just fine. And then finally the Russell 2000 is nowhere. It's still also below its 200-day moving average and a long upper shadow. Now we've seen a long upper shadow before, but long upper shadows tend to be pretty bearish. So so as bullish as that Hakinyashi candle look on the S&P, this is probably one of the bearish signs that we see going into next week. Now, I'm not talking about like long-term bearish. I just mean like going into next week. That's something to consider, especially at the 200-day moving average. So, the S&P looks great. The NASDAQ obviously is strongly bullish, but we're still not getting that broad participation yet in the Russell 2000. It's one thing for the Russell to play catch up because it's lagging, and with it to take off like it's done the last couple of times. It's another thing for it to play catch up when they both falter because the Qs come down because they're already so bullish and these others are holding their resistance. So that's as bullish as it is on the S&P, a little bit of a cause for concern here with the Russell 2000 and that long upper shadow. Let's take a look at the 3 green arrow chart, and you'll notice on the S&P 3 green arrows easily, and we're easily above the 8-day moving average. We touched it on the intraday basis, but I mean that's about as bullish as you can be. The MACD is high, the MACD average is high, and then you can see the stochastics and its average are well in the upper reversal zone. So strongly bullish. We talked about before that when you're bearish, the MACD doesn't do this. So that's a good sign that we're not bearish, right? That we can continue this bullishness going forward, especially when you look at like the RSI, and it's the RSI getting above 60 and staying this week. So good sign there. Here's what the Russell looks like. It also got above 60 this week. And staying there. The NASDAQ composite has been above 60 this whole time. So finally kind of joining the S&P, finally joining the party. The DMI, you can see the SPY has gotten above 30. Now a little bit of a pullback, and we got below 22 or 20 as well with the negative directional index, but it popped back up. So let's keep an eye on that to see whether or not it's going to be able to keep going. The QQQ still is below 30, so it's not to the point of not being able to being too extremely bullish. So it's got some more room. And then of course IWM here, you can see its negative directional index, even with this last couple days of underperformance, is still below 20, and we're easily above 30. So these are good patterns, bullish patterns. If you look at the Bollinger Bands for SPY, this is also a very bullish sign, getting up above this 300 point of control node, and so far staying up above. And you can see we had broken out above the upper band this week. We also broke out above the Keltner channel this week as well. The Keltner channel, so that was a good breakout pattern there. You can see the bands are breaking out outside of the Keltners, pushed to the upside in the upper half of the upper quartile of the bandwidth. You can see there. So strong bullish. One thing that stood out the last couple of days is this. These last 2 days on the S&P, down a little, up a little, right? If you look at the trend indicator, which measures declining volume versus advancing volume, let me show you kind of what that means here. If you take a look, if you look at the number 2, that kind of give you an idea of what it takes to get a 2 ratio. That means that you had a 2 times as many decliners as advancers, and 4 times as many as much declining volume as advancing volume. So that puts you at a 2 ratio. So and it could be the other way around, right? You could have a 2-to-1 advancer to decliner ratio, right? So that would be a 2 here. But then you can have a 1-to-1 declining volume to advancing volume ratio, and that can also give you a 2. You can see. And you can see how bearish that would be then, to have like so many advancers but not the volume to coordinate it, or to have so many decliners and even more volume on the declining volume. So that's what gets you to these levels. You can see the 20-day average is all the way up to 1.25. That's not typical for rallies. That's typical for pullbacks, right? That's when the 20-day average rises, and then then it moves to 0, and you can see, or 1. That's when your whatever the ratio is for advancers decliners equals the ratio of advancing volume to declining volume. That's typical, right? So during a bearish run, you can see, you tend to have more selling volume than advancing volume. So that's typical during declines. But right now, we're not getting a decline. During this run up from 1 up to 1.25, we're not getting a decline. We are, we're getting some volatility and choppiness, but we are rising. In the last 2 days have been 2 of the highest readings this whole rally, including, for that, and I'm talking about the histogram on the back here, including the end of the selling here during this run, at the bottom, and then forming the bottom and back up to the top. You can see the trend was actually really low on the other end. So you had good advancing volume versus declining volume. So this whole time we haven't had readings as high as we've had the last couple of days, and neither one of those days were selling days. In fact, we're higher than we were 2 days ago with all that declining volume relative to decliners. So a little bit of a red flag there too. Canary in the coal mine. Remember all those momentum line falling below 50 as well. Those extremely low momentum lines in this, just something that we don't typically see in strong bullish trends. So just keep that in mind. I just again suggest it's another reflection of how concentrated the move is. That when we're bullish, it's usually just a handful of tech companies that are leading the way higher. All right, now let's take a look at the intraday chart, and you can see I mentioned this today too on a tweet. This is where right here is May the 1st, right? So this is where we started. Here, let me bring my pen back up here. This is where we started back on May 1st, right at that level. So you can see by the time we got to May expiration from May 1st, we had gone up and down, but we were flat from the open, right? Because we gapped down there. From the open on May 1st, we had been flat. Then we gapped up, right? And then we went flat after the gap up. We gapped up again, and we were flat again until just a little bit of a bump here at the very end of the day. So from this level to that level, from this level to that level, right? And from here. So this is, we started the month essentially right here. So this, from this dot here to this high point here where we closed the month, most of that gap, that move occurred in these 2 moves right there. At the beginning of this week and at the beginning of last week, right? Most of that move of this month's gains occurred with those 2 gaps, and we haven't filled in those gaps, right? We haven't filled in. We filled in some of that gap. In fact, on the Qs, we actually have filled in that gap from this week, and we filled in most of the gap from last week. So we actually have filled in that gap. We just haven't on these other indexes because of IWM playing catch up, right? The IWM had played super catch up here, and we started to fill in some of that gap from this week, but we hadn't finished, and it's way far away. So again, if we're going to get any kind of weakness going into next week, that's going to be the reason why, right? That most of May's gains occurred in those 2 moves, and those are common gaps, right? And there's a very good chance common gaps get filled. It might take a week or 2, but there's a very good chance that common gaps like those get filled. Let's take a look at the volume. The volume actually picked up today. Was the highest of the week. We had it was the highest, and interestingly enough, this volume, the other really significantly bullish volumes were all, that was a big down day, and this was a mostly up day. We closed near the high. That's why it's more green than red there. So we closed right near the high point there. And then but you see the range was just under the average at 5.4 points. So when you look at this again, it's just under the average. So the range is kind of bottoming out, and the volume is above that number. So the volume is bottoming out. And we've already seen the other thing that's bottoming out is volatility. It's been up and down, but since that gap opened on Monday a couple weeks ago, volatility hasn't gone anywhere. It's been up and down, and it's stayed right hugging the 90% mark of its ratio to VXV. So that's a little. I mean, again, that's acting as a support. If there's any kind of support and resistance on volatility, it's down here on this ratio chart. And if you can't break the 90% level, then and we bounce and support holds and bounces, that's gonna lead to a jump in volatility, especially with the ranges on volatility. If I were to go to the range here to see what it's been doing lately, the ranges have really been shrinking. Way down the average range, way down from what, still a lot higher than what it was, but it's gotten a lot smaller here. And in fact, you can see, if I were to shrink this up and just look at it on a very, very short-term basis, to kind of give you an idea, it's really shrunk up. And over the past so many days, that range was super high. It was 20 points in 3 days, but it's now back down to some of these levels from last year. So that kind of gives you an idea of the potential for volatility to bounce again because of how much it's compressed. That's one thing about volatility. It's not just whether it's high or low, it's whether or not it's compressing or not, like a coiled spring. And so the more it compresses on a relative basis, this kind of throws off the scale of the rest of the chart. If I were just to zoom in over here, it won't scale for me. It won't automatically scale for me here. But this move here kind of throws off the scale. In fact, let's go all the way to February. Maybe we'll do it this way. If I do February the 21st from February the 21st of last year, so 1 year chart. There you can see the scale. So when the volatility compresses to these low levels, then you can get the bounce. That's when you get the bounces after the compression. And you can stay compressed for a while, but the more it gets compressed, even and this is on the relative basis here, the more likely you are to get the jumps, right? The jumps up higher. So we're not to that point right now, but we sure are getting a lot closer to compression. Back to where it was. So let's go back to just a regular 1 year chart, and you can see, it's as compressed now, as it has been. It's forming a kind of a base here. That's when you combine that base with the 3-day falling as far as it has been, it's setting up for a uncoiling, which it's not going to break down to the downside. It's going to grind down. It's going to break up and then grind. After that breakout, can grind back down. So we'll see how, when that occurs. If that occurs next week, then that will coincide with any kind of near-term weakness. If it might take a week or two of grinding higher in the S&P before that happens. But we see, that with where the NASDAQ is, we can get we can get an uncoiling here in this compression on volatility and still not be necessarily significant, right? Just be noise, simply because of how bullish we've been over the last 4 weeks. It makes the gap of where you can be noisy that much bigger than it was when you're just kind of slowly moving higher. So to summarize the technical outlook here before we go on to some intermarket things, it was a really good week for a bullish breakout patterns on a lot of these technicals. Is a very, very good week. We've made a big move to get here, kind of like a team that's so far behind, like a basketball team that's so far behind, makes a big push to catch up and maybe even take the lead, because it takes so much energy and momentum. They might lose the lead right afterwards, and just kind of a near-term pullback before potentially regaining and finishing the game strong. It's the same thing here. We've made a lot of energy and a lot of momentum to get back to these levels where like getting above the 200-day moving average and really regaining the bullish trend that we had previous to this COVID decline. Because it's taken so much energy, might run out of gas in the short term and retest that line. As long as we don't go too far below it, we might come back and retest it in the near term before then really taking off again with all these other indexes catching up and confirming the same technical patterns. So what do you think? Do you agree with that assessment? Do you disagree? Comment down below. Either way, whether you agree or disagree, comment down below. And especially if you disagree, show us why. What are you seeing? Share with the community what you're seeing that would suggest why you're either a lot more bullish than I am already, or why you think that any kind of pullback would be a lot more bearish than what I'm expecting. All right, now let's get back here and just talk about what's going on here this week and how these different asset classes perform this week. So let's just go to the beginning of the week, including the opening gap. So we started up a lot higher. The Russell especially started up a lot higher. By the end of the week, you notice the Russell lost all of its gains. So all that outperformance, now it had more outperformance in just a few days, but just for this week, all of its outperformance it had this week, it lost it all by the end of the week. Another interesting thing too is developed markets did very well. Emerging markets lagged behind, and they had a little bit of a bump here at the end to close the gap a little, but for the most of the week they had a big gap in performance between the emerging markets and developed markets. Crude oil helped provide the emerging markets that late gap, so crude oil rallied here, at least the USO ETF rallied here at the end of the day, and you can see the dollar had a really bearish week. So if we take a look at the chart for the dollar, and bonds were down too. But if you take a look at the chart for the dollar on the ETF that tracks the dollar index on a bullish basis, that's a pretty bearish candle. That's a bearish Heikin-Ashi candle. It's the first real significant bearish Heikin-Ashi candle that we had since right before the decline. Right, we had a pretty bearish, during the decline from in that March 2nd area. Really came down, and you can see what that candle looks like on a regular candles that move there, and then we had a big bullish spike during the worst 2 weeks of the declines, and after bottoming out, the dollar has been coming back down. So we're closing below the 200-day moving average, just like we did there. The last couple of times, we didn't go any lower. Once we broke below the 200, we didn't go any lower. Here it took a few weeks to get back above it. Here it took only 1 week to get back above it. So, are we going to stay below it this time? Or are we going to work our way back up, if not get back up above it next week? That's very, very important because, again, stock markets do more bullish on a longer term basis when the dollar is dropping. So getting below the 200 and staying below the 200 is really important to getting this death cross environment, which is very bullish for risk appetite. The long-term bonds also had a bearish week this week and closed below the 50-day moving average with a bearish Heikin-Ashi candle. So again, closing that gap to the 200 would be bullish for risk appetite. With falling momentum here would be a good sign for risk appetite as well. And then finally, the gold futures contract remains very, very high, but a little bit of a transition candle showing up here this week. So we'll see if it follows that weakness in it follows a weakness in bonds to the downside. Might stay bullish in the trend. If the dollar goes down, you can see during 2017, this was a very, very bullish year for stocks, and gold rallied. So all the way up to early 2018. So just because stocks were bullish, and very bullish too, and very historically low volatility, doesn't mean gold has to drop. So gold can still rally with a weakening dollar. So gold can still rally, but probably not to the tune of how bullish it's been, right? It took off here because this was a bear market and risk appetite. We didn't see it here in the U.S. because Qs led us up. Very similar to the late 90s, but this was this has been a bearish market for risk appetite as a whole, and gold has gone parabolic as a result of that. So we'll see if that continues to play itself out going forward from here, and might maintain some bullishness, but a lot slower. Again, because of the weakening dollar. But considering its parabolic move here, don't be surprised if we get some weakness in gold during this move, this bounce, a breakout above these long-term moving averages in equities. Finally, let's take a look at crude oil. Crude oil, which has been so crazy, you can see it's making a nice, good, solid run with some good bullish Hakunashi candles, getting back up to the 200-day moving average. It's crazy to think that right before this corona issue, we were trading in the 50s. And then, of course, it got to the negatives before rallying back up to now the mid-30s. But, again, the mid-30s seems very high because of how low we got. But the reality is that's actually still pretty low. And that's why, again, there's no, economic... The stock market's really bullish, but from an economic standpoint, which is what commodities kind of more reflects, there's still not a lot of expectations for significant economic growth here anytime soon. But that's okay. Commodities are lagging. That's the nature of them, and it's okay for them to lag as long as they don't, like we said, fall through the floor. And boy, how did they ever fall through the floor? And so did the stock market as a whole. But now that they're not falling through the floor, now that we're rebounding, as long as we continue to maintain, even if it's lagging, some bullishness, then equities can maintain their bullishness. Risk appetite as a whole can maintain their bullishness. One thing, too, I mentioned on bonds kind of reversing. Here's the 10-year note, how bearish it's been, how significant its PPO is. You see it's rising. And you also see that we're flirting here with trying to get through this 50-day moving average. The gap between the current level and the 50-day is really shrunk as the 50-day is plummeted here. So with that rising PPO, and the chance that we can, an easier chance to break through the 50 than we've had in weeks, then that's going to be a good sign, especially for like the financial sector. That sector has been really beaten up here. And if I were to go all the way back to where the selling started, so we peaked on the 19th, and then had 2 down days before February expiration, and then it really started from there. From that peak through the bottom and back up to the top, you can see financials have just struggled. They were the biggest loser during the decline, and they haven't gained enough to recover that since the low point. And same thing with industrials. And you can see the safety trade started off strong, but then as we've rallied, they've really pulled back, and real estate especially. So if you notice, energy also is, it fell the worst out of everybody. And it's also still, down 28% from that February peak. So some of these sectors are still struggling and still kind of coming up. And financials especially because of the yield situation. You can see healthcare is almost back to where it was. Not surprising. It's had a big role in this recovery. And then you can see technology, discretionary, and communication services. See, they've been outperforming most of this time. So their outperformance, their leadership is not a new leadership. In fact, on a year-to-date basis, if you go all the way back to January the 1st, on a year-to-date basis, they're back to positive. XLY is pretty close. Healthcare is there. So on a year-to-date level, they were already bullish going into this. And interestingly enough, so were utilities and real estate. They were bullish going into this. They maintained their bullishness throughout this whole time. Even if I go back even further towards that kind of October low point that we had, where we kind of bottomed out there, is October the 8th, it looks like. From that October the 8th low point, there we go. So from that low point going forward, you can see, look at the outperformance technology had. This is not, and there's discretionary, or there's communication services outperforming most of it. Discretionary is lagging behind, but again, that's a lot of that's Amazon. But you can see it has since caught up and passed the S&P, and there's discretion, there's technology. Again, off of that October low point, technology is up 22%. Even with this, this is not a bear market. So, if technology is back to being 22%, then, back, for this period, and it's pretty much a year period. If, you go to a year period, technology is up 34%. That's not a bear market. You don't have a 1-year return. You don't have a sell-off during a 1-year period where things still end 34% higher, or stocks as a whole end up 8% higher, and there's communication services and discretionary along with healthcare. So their leadership is not new. And it's not going to be short-lived either. You would expect that they'll continue to lead, and you can see financials and industrials have been lagging this whole time. Their weakness has not been new either, and you would expect that they'll continue to lag. You would hope that they would start to outpace the S&P a little bit at least, because of how much they've lagged. But you can see why they've struggled. Yields or financials mainly because of those yields. But if yields start to turn things around, then you've got some opportunities in that sector, which is the basis of today's trade idea. So if you look at a stock like USB, if I pull up the Bollinger Bands here, it's really struggled, right? I mean, since this February, we were trading at 60 bucks. U.S. Bancorp here at December expiration. Sorry, there's your February. It was already bearish going into the February expiration where everything fell off. So that kind of shows you just how bearish this is. But it's been flirting with getting to relatively strong bullish levels. In fact, this volume node that we have been forming over the past couple of months, we've taken a couple of times of breaking up through. This time has been more significant, and we're kind of breaking into the value area. You can see some of the indicators. In fact, on the long-term chart here, on its 15-200-day moving averages, you can see how bullish that Hakinyashi, the first bullish, real strong bullish candle we've had on these little bounces here. So that's one thing that stands out. The other thing too that stands out, when we were looking at this during the Market Outlook Live, we were actually above the 50-day moving average. So you can see the potential it has to get above this 50 now, a lot easier than it was a couple weeks ago. Last time we had a long upper shadow. We were a lot further away from the 50 on that week. We're right there this week. So an opportunity to fill in this gap, especially with very little volume, very, very little volume. Once you get above this peak here, 38, it doesn't grind its way through. It grinds its way through volume. When there's a lack of volume, it can move just as quickly. As quickly as it moves to the downside, it can move just as quickly to the upside because there's nothing holding it back. There's no significant resistance levels holding it back. So it gives us an opportunity, especially with earnings before July expiration, to be a little bit speculative, knowing that if it doesn't move, I've got support below and I can take a small risk. And if it does move, like this is based on current options expiration, or this cone of expiring, is based on current volatility levels, which are rather elevated because of the earnings that's coming up. But if we get to 41.82 by July expiration, we're not going to be. Look how you're in the volume gap. You're going to move very, very quickly through 41.82. So that sets us up for. And you can also see too, for example, on the MACD, on its MACD and stochastics, the stochastics moving average is getting higher than it has, right? During these other bounces, the moving stochastics, the moving average for the stochastics is getting to a higher level. The MACD itself is getting to a higher level than it did on either of these two. The average for, in fact, it's crossing back above zero. So we have an opportunity for a good move to occur out of this based on that. You can also see too on its DMI, the other significant two that stood out, the other difference on this bounce versus the other couple of bounces here was these two, like that got above the blue line and it came back down. This got above the blue line and it came back down. You can see now, and the others, these moves, this one here, we weren't above the price. This one we did get above the price, but came right back down below the price. So now you can see where we're at. We're above the price here at current levels. If we were to bounce up from here, we can stay above the price. And this one got above the blue line. This bounce got us up to the cloud, and we hit it for resistance and rolled over. Now we are through the cloud, and the green line, the Tenkan line, is also going through the cloud, and the blue line has a chance. So it can really easily move through this cloud. Remember, as it moves into this area up to 40 and beyond, there's no volume here because of how fast we drop. So it's going to be very easy for us to get through the cloud and up above it. And that's kind of the idea, the basis behind this trade. What we've done, or what I did on USB, was we looked at selling the 42.5 call option. Remember, 42 is right about where the first standard deviation level is, but right at the bottom of that huge volume gap. So if we get there by July, especially with that earnings, it's probably not going to just be getting there. It's going to more than likely blow through there, which would be good for this. So we bought the $40 out of the money call option and sold the 42.5 to somewhat offset that cost. That keeps my risk really small. So with 12 contracts, I've got less than half of my normal position that we normally put on. So very, very small risk, and it'll be very easy to keep my risk, to a couple $100 below that. So because worst case scenario is only 450, but if I can keep it to a couple hundred, great. But if it works out and we blow through this, then for that couple $100 of risk, I can make a $2,500 reward. That's a very good reward to risk ratio. It's a flyer, right? If yields take off, this has a good chance to take off too. If they don't, then I can either get I'll get some kind of small loss in the meantime. And I'm more than willing to take a couple $100 loss if I've got the potential of 10 times the reward going forward from here if this does blow up. So, it's it's an opportunity, kind of an example of an opportunity to take a really speculative directional trade on a really beaten up issue if it were to break out like some of these other beaten up issues have. And that's our video for today. Now's our time to hear from you. There's a link popping out right there on the top right corner of your screen. Click on that link. It takes us to our Market Outlook forums. Post any questions or comments, and let's keep this conversation going here over the weekend heading into Monday. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, join our website and our community at Market Scholars, as well as our Facebook group that we've created, and follow me on Twitter for more content in between the videos. Again, thank you. Have a great rest of your weekend, everybody, and we'll see you all on Monday.